You have a TFSA. You want to know what ETFs to buy in the TFSA. Well, today we're going to go over 4 staple options to consider. Now, the reason this video is specifically focused on the TFSA is that it is slightly different when investing in your RSP. Take the topic of withholding tax, where certain investors will prioritize US investments or US funds in the registered retirement savings plan. In a non-registered or taxable account, you have the ability to write off losses. If you unfortunately have losses, this may factor into the amount of aggression or risk you're willing to take. While these are minor things, they may ultimately factor into the decisions you make. Today, we're focusing on the TFSA. These are, of course, just my opinions. Do your own research, do your own due diligence. But starting with fund number 1, it's VFV, the Vanguard S&P 500 ETF, getting you exposure to the 500 largest companies in America. And the fund that we're going to be covering today is ticker VFV. This is what you'll be punching into your brokerage account after you do your own research and due diligence and deem this is something you want to look into. It's the Vanguard S&P 500 Index ETF. The objective of this fund is very simple. It's to track the 500 largest companies in America. An ETF, by the way, for any of our pure beginners, I always like to envision it as a basket. It's like a basket with a bunch of different stocks or assets within it. In this case, ticker VFV, the top 10 holdings in this basket today sit at NVIDIA, Microsoft, Apple, Amazon, Meta, Broadcom, Alphabet, Tesla, Alphabet again, and Berkshire Hathaway. Now, of course, these are just the top 10 included in the basket as of today. There's going to be 490 essentially other companies and holdings that you can absolutely go look into, but these are really the top of the index that's going to be driving a lot of the returns. Investing in a fund like VFV is getting you exposure to the multi-billion-dollar and trillion-dollar companies that are really at the forefront of pushing our world forward. To dive into the sector breakdown, or essentially the allocation of where your dollars invested in this fund will be situated, today we see a high weighting to infotech or technology, so the tech sector, 35%. We have the financial sector coming in at the second largest, 13%, consumer discretionary, consumer staples, 10%, healthcare, industrials, so on and so forth. One of the strengths of investing in the US market is that it is not only a developed market, but it is relatively diverse, and it's getting you exposure to tech, which is something that you will not really get when investing in the Canadian market, which we're going to talk about in a second. It should go without saying, but this fund is 100% allocated to North America. To be more specific, it's allocated to the USA, American companies and American stocks. In terms of returns, this is of course a passively managed product or fund, meaning its job is to simply passively track an index, the S&P 500 in this case. We see that over the past 10 years, it's averaged a return of 15.5%. For the past 5 years, 17%. We've had strong performance in the recent years, up 24% per year. Per annum, 25% we see here, and the past year up 20%. Another way we can view this here is in this table. Feel free to pause the screen, you guys. I will include this all down below. And last but not least, very important to cover off here, when we do invest in an ETF or a fund, there is a fee associated with this fund. We have the option of going out and buying all these stocks individually one by one and building a portfolio ourselves, or we can buy this bundled product. There is a fee associated with that. It's known as the MER, the management expense ratio. In this case, this is one of the lowest fee products you will find here in Canada, sitting at 9 basis points. What that means in layman's terms is essentially for every $100 that you invest into this product, you'll be paying about 9 cents per year in fees. You can obviously scale that up depending on how much you're investing, but at the end of the day, a very, very low cost product getting you broad exposure to the US market. So VFV, in my opinion, is a staple option. In fact, I have about half of my personal portfolio situated in the S&P 500. But now that we've covered a product for American exposure, what if we want to invest in the Canadian market? Well, that's where fund number 2, ticker VDY, comes into play. The Vanguard FTSE Canadian High Dividend Yield ETF. And this fund as well happens to be brought to you by Vanguard. They're what we would consider the fund provider or the ETF issuer, of course, a different ticker. And as the name implies, this one is getting us exposure to the Canadian market. Now, not just the Canadian market, but if we zoom into the fund objectives, it is tracking the FTSE or FTSE Canadian High Dividend Yield index, meaning that this basket is comprised up of Canadian companies that are categorized by a high dividend yield. And what we notice right off the bat is that the dividend yield on this fund today sits at 3.55%. Now, I didn't even bother mentioning the dividend yield on our S&P 500 fund that we just covered in the previous segment because the S&P 500 isn't really known for their dividends. A dividend, by the way, is when a company or stock that you own and hold in your portfolio, when they take a portion of their profits and distribute it or share it, give it to you back as a shareholder simply for holding the stock, you will essentially be receiving quarterly, so every 3 months, dividend payments into your portfolio. It's a very sought after form of passive income. Now, what types of companies are typically known for paying great, reliable dividends? We think to more mature areas of the market, more dinosaur-esque industries, if you will. I think of things like the insurance sector, things like utilities and natural gas, oil companies, banks. Now, when we think about where the Canadian market excels, well, let's go down and look at the holdings and take a look at what companies are included in this basket. Well, this list right here sums that all up. We have the Royal Bank of Canada, TD Bank, Enbridge, Bank of Montreal, Bank of Nova Scotia, CIBC, Canadian National Resources, TC Energy, Manulife, Suncor. Interestingly, we see the sector breakdown and they happen to fall into just a few major categories, whether it be financial, whether it be energy. In fact, here we really see this depicted with over 55% of this fund allocated to the financial sector, energy coming in next, utilities coming in at a 5% weighting. What's very important to understand is that the breakdown of the Canadian market and economy, if you will, is quite different than that of the American market. The American market tends to be a lot more diverse. And of course, this is a fund focusing in on dividends. But if you were to just look at the Canadian market breakdown, it does fall quite concentrated within a few major categories. One thing that Canada isn't overly known for is spitting out amazing tech companies, other than maybe Shopify, if you will, and maybe a handful of others, but Canada is known for having some super great, reliable dividend companies. This is a fund that over the past decade has averaged a return of 12.5%, 12.3%, 20% over the past 5 years. Over the past year, 25%. We did glaze over the dividend yield here, but very important to understand for those beginners out there, what this means is that depending on how much money we invest into this fund, this is the yield that we can expect to receive in dividends from ticker VDY. So essentially on a 3.55% starting yield today, if I were to invest $100,000 into this fund, over the course of a year, I would expect to earn about $3,550 in dividends / passive income. The fee here, or MER, sits at 0.22%. Again, on every $100 that we invest, what that means is that we'd be paying about 22 cents per year in management fees. So now we've covered a US fund, a Canadian fund. Maybe in your portfolio, you have a little combination of both to complement each other, but maybe you are a lazy investor just like me. You don't want to pick multiple funds. You don't want to worry about rebalancing or allocating this or that. Well, this is where fund number 3 comes in. It is ticker ZEQT, the BMO All Equity ETF. Now, this is a fun and interesting one. This is, of course, brought to you by BMO, so a different issuer than the previous two that we covered. The ticker you'd punch in your brokerage account is ZEQT, and this is what is known as an all-in-one ETF, where essentially the previous funds that we looked at, they're getting you exposure to a bunch of different stocks. Well, with ZEQT, if we jump over to the holdings, what we'll see is that it owns 6 holdings within this basket. You may be thinking, how could a fund or ETF with only 6 holdings be diversified or a sound investment? Well, if we dive in, we'll see exactly why. It is a fund that owns other funds, so 6 underlying ETFs. About half of this fund is allocated in and of itself to the S&P 500. Here using ticker ZSP, which is BMO's version essentially of VFV, meaning within this fund alone, you're already getting exposure to the 500 largest companies in America. It then allocates 25% or a quarter of the fund to the S&P TSX Cap Composite Index. Let's just call that the Canadian market. If this fund goes out and tracks the US market, well, this one goes out and tracks the Canadian market, ticker ZCN. It has exposure to the MSCI EFI index, which is an international index, getting you exposure not only to North America, but to companies all over the globe. We see an 8% exposure here to even the emerging markets index and some small exposure to US mid-cap and small cap companies. You see what I mean when I call it an all-in-one ETF. You need to buy just one fund, ZEQT, but under that fund, you're getting exposure to 6 underlying ETFs. I mentioned this is a fund great for lazy investors such as myself because it essentially does everything for you. It's a one-stop package shop. If we look at how diversified your dollars would be spread across the various sectors, you have a healthy weighting to tech at 23%. You also got financials. You also got industrials, consumer discretionary, all the way down through to staples, utility, and real estate. Importantly, here's when we look at where your money is distributed across the globe. Again, half of it sits in the US, a quarter is allocated to Canada, but you're also getting some cool exposure to companies in Japan, China, Europe, or United Kingdom, Taiwan, the list goes on. In lieu of time, we're of course not going to go through and dive into every one of these underlying ETFs, but you absolutely could do that while you're doing your research and due diligence. You can see the various tickers right here of where your dollars will actually be deployed. One of the best advantages, in my opinion, of a fund like this is not only are you getting the global exposure and having everything essentially, like an entire portfolio packed into one single fund for you, it automatically rebalances to make sure that this fund is on target. In terms of returns for ZEQT, what I will call out here is the inception date. This is a fund that was just incepted essentially a few years ago, January 2022. So when you look back at this data, you're not gonna have the 5-year, 10-year numbers, but what we see is over the past 3 years, 22%. Over the past 2 years, 25%. Year to date, up 16%. Since inception, 13.88%. While we don't have these numbers populated here, because these funds invest in the underlying holdings, you could obviously go up and look up these funds and have a pretty good expectation of what to expect. All in all, this is a fund that I think is a tremendous option for those who want to set it and forget it. The lazy investor who doesn't want to worry about their own allocations of multiple funds and picking and choosing. This fund essentially does it all for you for a very fair and actually recently reduced management fee. What you'd be looking at in terms of cost is 20 basis points. Again, that'd be 20 cents on every $100 that you invest. And fun fact, by the way, we just covered ticker ZEQT, which is the all equity or 100% allocated to stocks or equity version. You do also have the option of going for example, that's a Z, ZGRO, that's a G, RO, ZBAL. Those are terrible writings. Basically the option to incorporate some fixed income into the mix if you're maybe an older investor or someone who maybe just wants to be a little more conservative. That said, let's finish off this video with fund number 4. It is ticker QQC, the Invesco NASDAQ 100 ETF. And I do believe that this fund here, brought to you by Invesco, does deserve a spot on this list. While somewhat similar to the S&P 500 fund we covered, this one is slightly different because it tracks the NASDAQ 100 index. Now, what is the NASDAQ 100 index? Well, this index consists of the 100 largest non-financial companies listed on the NASDAQ. While getting you generically American exposure, a great way to illustrate the difference between the S&P and the NASDAQ 100, the S&P we can think of as more of the broader American economy, spread across multiple different sectors, more diverse. The NASDAQ 100, as we will see here, I'll actually jump to this one, which is QQC.F, FYI, I'll include both below. We do see an even heavier skew at 55% of the fund allocated to the tech sector. Think about the innovative companies that are really pushing the world forward. If you do want to be a little more aggressive, if you will, or if you're one of those people, which I know there's a lot out there who happen to be more convicted on tech, the NASDAQ 100 is going to get you more of that exposure. Of course, we do see other sectors represented here, like telecommunication services, consumer discretionary, consumer staples, essentially just non-financial. If we jump back over here to take a look at the actual underlying holdings that you'd be getting exposed to, what we see is the big tech players. So Nvidia, 9.5%, Microsoft, Apple, Broadcom, Amazon, Tesla, Meta, Alphabet, Netflix. Very, very similar to what you get with the S&P 500. It's certainly at the top weighting of these funds. It's just gonna be a little more concentrated. If we were to look at the performance or the returns, this fund as well, based on its inception date, doesn't provide us the longer term data, but again, it's simply tracking the NASDAQ. But we see over the past 3 years, a 31% return. 1 year return sitting at 27%, 6 month 24, year to date up 14%. Since inception, this fund is up 18.91%. What I will call out is a NASDAQ fund by nature, due to the concentration in tech, it is going to be more volatile. when compared to the S&P 500. So during periods of boom, and over the past few years, we've seen tremendous performance in the tech sector, a NASDAQ fund is going to really benefit from that. There are periods and there will be periods where tech in particular is an area that struggles. This is a fund that would get hit harder. I don't want to make it seem like this is an overly aggressive fund, to be clear. In fact, as we can see here, who this ETF is for. It's for those who want capital growth over the long term. They want their US equity exposure, plan to own other types of investments to diversify their holdings, and are comfortable with a medium to high risk. Medium to high risk, that is not buying penny stocks. It's not going out and buying meme coins. The NASDAQ 100 is a tried and true index. All I'm just trying to say is that it is going to be a little more volatile. And if you're an investor that deems you're comfortable with those ups and downs, it absolutely could earn a spot in the portfolio. The management expense ratio, or the fee that you pay with this, again, right in the range of what we've been discussing today, sitting in at 21 basis points or 0.21%, meaning of course, for every $100 you invest into this fund, you will be paying 21 cents per year, essentially in fees. So in summary, you guys, these are just 4 ETFs of the millions, not millions, but there's many, many, many options out there that you could choose from. I just think this is a great starting point for those that are new and hopefully provided a bit of variety. If you're new and want to learn more, my father, Mark, and I offer online training for complete beginners. We've helped thousands of Canadians go from zero knowledge to standing up on their own 2 feet as an investor. I also co-founded an app with now over 500,000 users called Blossom, a completely free resource and an incredible place to learn. Links for everything will be down in the description below.